According to International Business Times, Palantir CEO Alex Karp has made a striking prediction about how artificial intelligence could reshape wealth, both for himself and for the broader economy. In this episode, we'll unpack what his comments might mean for Palantir's stock, for the AI sector, and for investors trying to position themselves in a world where the gains from technology may not be shared evenly. According to International Business Times News, Karp told the MD Meets podcast that AI could potentially make him roughly 20 times wealthier than he is today, implying a personal fortune approaching $300 billion. At the same time, he suggested that many middle-class workers might see their incomes only double over roughly the same time frame. For stock investors, that contrast points directly at a central question: will AI mainly enrich the owners of the technology platforms, or will it also deliver broad-based gains that sustain political and social stability over the long term? International Business Times mentions that Palantir's own market value has risen to the mid-hundreds of billions in dollars, lifting Karp's wealth into the mid-teens of billions. Whether or not current exact figures are precise to the dollar, the direction of travel is clear. Markets are assigning a very high valuation multiple to companies perceived as core AI infrastructure or mission-critical software providers. For investors, that kind of run-up has two implications. First, it confirms that capital markets believe AI leaders will capture substantial economic rents. Second, it raises the stakes. If expectations embedded in today's valuations are not met, the downside can be significant. According to International Business Times, Karp argues that AI's impact on living standards will be uneven. He expects that average workers will see some uplift in wages and quality of life, but that the people who build, own, and control the technology could become 10 to 100 times wealthier. This is a crucial frame for investors, especially those who look at long-duration growth stories. If AI compounds inequality too aggressively, it can trigger political responses, regulatory headwinds, new tax regimes, and public pushback, all of which could affect margins and growth trajectories for listed companies. From an investor's perspective, Karp is effectively saying the quiet part out loud. Many bulls on AI-linked equities are implicitly assuming that the owners of data, models, and infrastructure will reap disproportionate profits. Karp is explicitly validating that thesis from inside the industry. He is simultaneously warning that this creates what he calls a problem for society. When a CEO acknowledges that his own potential gain from a technology could be many multiples of what average workers see, investors should think beyond this quarter's earnings and ask, how sustainable is that distribution of benefits? International Business Times reports that Karp also took aim at what he sees as overselling of AI. He remains one of the sector's high-profile advocates, yet he criticizes exaggerated claims about current capabilities. For Palantir shareholders, this tension matters. On the one hand, cautionary statements can bolster credibility. Investors appreciate leaders who avoid hype and focus on real, defensible use cases. On the other hand, capital has been flowing most aggressively toward the loudest narratives. A more measured tone may slow down speculative inflows, but could ultimately support more stable, fundamentals-driven valuations. From the standpoint of an equity analyst or active investor, Karp's comments invite a closer look at how Palantir actually makes money from AI, and whether its revenue mix positions it closer to the durable, infrastructure-like side of the AI economy or the more cyclical, hype-driven side. Palantir builds data integration and analytics platforms heavily used in government, defense, and increasingly in commercial sectors. Its AI-driven product suites, like platforms for decision intelligence and autonomous operations, are not simple consumer apps, they're embedded in mission-critical workflows. That positioning suggests that if AI does create massive winner-take-most dynamics, Palantir aims to sit near the center of that winner's circle. Karp's discussion of who benefits from AI is also important. According to International Business Times, he describes AI's biggest winners as people the broader public may not identify with: highly technical, highly specialized individuals who may feel culturally distant from mainstream society. For investors, that cultural gap is not trivial. Perception risk can translate into regulatory and political risk. When the public sees astronomical fortunes being made by a small cluster of founders and executives, while wage growth is modest and job security feels fragile, the policy conversation can swing rapidly toward windfall taxes, antitrust moves, or constraints on data and model usage. International Business Times notes that concerns about rising wealth concentration long predate the AI boom. Global billionaire wealth has been growing much faster than average incomes, with organizations like Oxfam highlighting data that show multi-trillion-dollar aggregates at the very top. In that context, AI is not creating inequality out of nowhere, it is accelerating existing trends. For investors, the risk is not simply that some individuals become very rich, but that entire business models are built on labor displacing automation without adequate mechanisms for sharing the resulting productivity gains. From a portfolio strategy angle, this raises several questions. How should investors weigh the upside of owning dominant AI platforms against the tail risk of policy backlash? Should they tilt toward companies that present AI as an augmenting tool for workers rather than a replacement? Should they favor firms with clear, proactive ESG narratives around retraining, job creation, and societal contributions? Karp's own framing, where he positions himself as a critic of overselling and as someone alert to inequality, can be interpreted as an attempt to preempt parts of that backlash. According to International Business Times, Karp's projections about his personal wealth are still speculative, not guaranteed outcomes. For listeners looking at Palantir stock, it's crucial to separate narrative from earnings power. A 20-fold increase in his net worth would require either an enormous rise in Palantir's valuation, or substantial new equity-linked compensation, or both. That in turn would require very high and sustained growth in revenues, earnings, and free cash flow. It would also require markets to keep paying a premium multiple for Palantir's role in AI. So, what would need to happen at a business level for such a scenario to even be plausible? First, Palantir would need to remain a central player in AI-driven software and analytics for governments, defense clients, and critical industries such as energy, manufacturing, and healthcare. Second, it would need to translate that centrality into pricing power, high retention, and strong margins. Third, competitive threats from hyperscale cloud providers, open-source alternatives, and new entrants would need to be managed effectively. Finally, the regulatory environment would need to remain permissive enough to allow large-scale monetization of data-driven AI solutions. International Business Times also sets Karp's views in the wider landscape by mentioning voices like BlackRock CEO Larry Fink and AI pioneer Geoffrey Hinton. Fink has warned that early AI gains are flowing primarily to the owners of the models, data, and infrastructure. That should resonate with any investor holding positions in chip manufacturers, cloud platforms, or high-end software firms. These are the layers of the stack where margins can be exceptionally high and market power can be entrenched. Geoffrey Hinton, on the other hand, highlights the risk that AI could replace large numbers of workers while concentrating profits among relatively few owners. For equity investors, that's a mixed signal. On the bullish side, automation can dramatically boost productivity and profitability for the firms controlling these technologies. On the bearish side, widespread job displacement can sap aggregate demand, fuel social unrest, and provoke regulatory intervention. In the long run, equity valuations depend not only on corporate earnings, but on the health of the societies in which those companies operate. International Business Times cites JP Morgan Chase CEO Jamie Dimon as more cautious on some inequality narratives, yet still acknowledging that many lower-income Americans have been left behind. That nuance matters for investors who want to assess whether extreme pessimism on inequality might itself be overdone. Dimon's stance suggests that while headline inequality numbers are alarming, the lived experience is uneven. Some groups are doing relatively well, others are clearly not. AI will likely magnify those differences, benefiting knowledge workers in adaptable industries more than workers in routine, easily automated roles. Turning back to Palantir specifically, investors should consider how the company's customer base interacts with these macro forces. Palantir does substantial work with governments and defense agencies. On one level, that supports resilience. Sovereign clients can provide durable, multi-year contracts, and security-related use cases may be less sensitive to short-term economic cycles. On another level, that exposure can place Palantir squarely at the center of debates about surveillance, civil liberties, and the use of AI in defense. If AI-driven tools are perceived as too powerful in the hands of governments, or as exacerbating inequality and social control, Palantir could face both headline risk and potential contract scrutiny. From a valuation standpoint, Karp's candid comments may actually help sophisticated investors cut through narrative noise. Rather than pitching AI as a universally liberating force, he frames it as a powerful amplifier. It raises the average standard of living somewhat, but supercharges the wealth and influence of a small subset of firms and individuals. That framing is more aligned with how past general-purpose technologies have played out. Think about the internet and mobile. Yes, they improved daily life globally, but the bulk of equity wealth accrued to a handful of platform companies. This vantage point leads naturally to an investment thesis around AI that focuses on platform and infrastructure owners. Companies that control foundational models, critical data pipelines, and large-scale compute infrastructure are, in effect, toll collectors on the AI economy. If Karp is right, the public equity winners will be those that sit at these choke points. The risk, of course, is that as their dominance becomes too visible, they attract regulator attention and potentially face forced unbundling, data access mandates, or special taxes on extraordinary profits. International Business Times highlights Oxfam scenarios in which a very small wealth tax on the ultra-rich could still leave them among the wealthiest individuals in history while materially reducing global poverty. Whether such taxes materialize at scale is unclear, but as an investor, it's reasonable to factor in a non-zero probability of future wealth taxes, higher corporate tax rates, or targeted levies on AI-related rents, especially if the political narrative shifts further toward viewing AI as a driver of destabilizing inequality. For individual investors in Palantir or similar AI-exposed names, there are several practical dimensions to watch over time. First, monitor revenue composition. How quickly is AI-labeled or AI-powered product revenue growing relative to legacy analytics and consulting? Second, track customer concentration. Is Palantir diversifying beyond core government clients into a broad base of commercial customers in diverse industries? Third, keep an eye on margin trends. AI-driven software at scale should support attractive gross margins, but heavy upfront R&D and infrastructure investments can compress margins temporarily. Another angle is governance and compensation. If Karp's personal wealth projection rests partly on very large future equity awards, shareholders should evaluate whether those awards are tightly tied to value creation for all shareholders, or whether they risk excessive dilution. Long-term investors tend to favor pay packages that link directly to metrics like total shareholder return, free cash flow growth, and return on invested capital. International Business Times notes that Karp is skeptical of exaggerated promises about what AI can do right now. That skepticism can be a double-edged sword in the public markets. On the positive side, it might mean Palantir is more conservative in recognizing revenue, more realistic about customer timelines, and more focused on deployable, high-value solutions. On the negative side, more conservative guidance can sometimes lead to the stock being overshadowed by higher beta names that talk more aggressively about transformative AI. For patient investors, that gap between narrative and execution can be an opportunity, provided the underlying business keeps compounding. Looking beyond Palantir, Karp's remarks can help shape how we think about sector allocation. If AI benefits accrue most strongly at the top of the tech stack, then investors might overweight companies with strong moats in data, infrastructure, and highly specialized software, while being more cautious on commoditized applications. However, the inequality narrative also argues for balancing AI exposure with holdings in sectors that serve mass market demand and benefit from rising average living standards, such as consumer goods, healthcare, and services. There is also a time horizon dimension. Over shorter horizons, markets may focus primarily on the upside story, rapid AI adoption, revenue growth, and margin expansion for leading firms. Over longer horizons, the inequality story grows more salient. If societal pressures mount, they can alter the economics of AI in ways that today's models do not fully price. Long-term investors may want to ask whether the AI leaders they own are actively investing in workforce transition, education, and reskilling, and whether they communicate these efforts clearly to stakeholders. In summary, International Business Times brings us a narrative in which a key AI CEO openly anticipates extraordinary personal gains from AI while acknowledging that average workers will likely see far smaller improvements. For investors, that's a candid glimpse into how insiders view the distribution of AI's benefits. It reinforces the thesis that AI can be extremely lucrative for platform owners, but it also highlights the social and political frictions that can follow. As always, nothing in this discussion is investment advice. Investors should conduct their own research, examine company filings, listen to earnings calls, and consider their own risk tolerance and time horizon before making any decisions. Karp's comments are one data point, but they are a particularly revealing one about how the leaders of AI-driven firms think about the future. Thanks for listening to this episode. If you found this analysis helpful, consider subscribing and sharing the podcast so you don't miss future deep dives into the intersection of technology, markets, and society.